Welcome to vTalkInsight, Market Drivers Daily for March 23, 2026. Energy, geopolitics, and rates are colliding today as the Strait of Hormuz shock forces markets to reconsider just how long oil and yields can stay elevated. The central macro story is that the Gulf conflict has moved from a temporary scare to a structural energy shock. The closure of the Strait of Hormuz and damage to more than 40 regional energy assets have removed roughly 10 million barrels per day from the market, displacing around 17% of global oil and leaving an 8 to 9 million barrel daily deficit, even after offsets. Middle Eastern grades are trading above $150 in some physical markets, while front-month Brent has surged more than 50% in just 16 trading days and is oscillating in the 110 to 115 range. Futures curves now signal that this is not just a spot squeeze. The Brent and WTI curves have flipped from steep backwardation to a clear higher for longer profile, with deferred contracts rising more than spot. Markets are increasingly entertaining scenarios where crude reaches $150 in April. And in a prolonged strait closure, some participants are gaming out $150 to $200 stress cases. This energy shock is bleeding rapidly into the broader macro picture. Gasoline near $4 per gallon nationally and diesel and jet fuel that have more than doubled in 3 weeks are squeezing households and corporates at the same time. Airlines like United are flagging up to $1 billion in additional annual fuel costs and warning of higher ticket prices, while elevated pump prices are seen as a critical threshold that historically coincides with slowdowns, as in 2008 and 2022. The result is a clear rise in stagflation risk. Higher oil is feeding directly into goods and services inflation, with diesel and gasoline expected to push up logistics and manufactured goods prices globally. Lower-income consumers are disproportionately hit, threatening to undercut consumer spending, while corporates face margin pressure that could spill into weaker earnings and credit stress if sustained. Regionally, the shock is uneven. Asia ex-China and parts of Europe, heavily reliant on Gulf crude and LNG, are most vulnerable, with some East Asian countries already facing critically low inventories and beginning to curtail industrial activity. By contrast, U.S. energy dominance and relatively stable domestic natural gas prices offer a buffer, supporting a stronger dollar and oil-linked currencies like the Norwegian krone and Canadian dollar, while import-dependent currencies and those with low reserves, such as Australia, face downside risk if disruption persists. Safe havens are not behaving in a textbook way. Gold has sold off sharply, down more than 5% in a single day at one point, and over 20% since the conflict began, as investors raise cash, respond to higher real yields, and in some cases liquidate to finance energy needs. At the same time, base metals like copper and aluminum have a constructive longer-term backdrop, with expectations of increased strategic stockpiling and military spending once the immediate crisis stabilizes. On the policy side, the Federal Reserve and other central banks are being pushed toward a higher for longer stance. Short-term inflation risks have re-accelerated through energy, while longer-term expectations remain broadly anchored, encouraging the Fed to hold rates rather than react mechanically to every oil spike. The political calculus is complicated by rising domestic pressure in the U.S. from gasoline prices, equity weakness, and higher yields, encouraging the administration to signal de-escalation when possible, including postponing strikes on Iranian infrastructure and exploring talks over reopening Hormuz. There are meaningful countercurrents. Iran's missile and drone capabilities and naval assets have reportedly been significantly degraded, which may limit its ability to sustain a full blockade, and some Gulf producers pre-positioned close to 100 million barrels of crude outside the region, providing limited but real buffers. Strategic reserve releases by the U.S. and Japan, higher refinery utilization, and rising Venezuelan output all offer incremental relief, though they fall well short of replacing the roughly 20% of global supply currently at risk. From here, markets are fixated on the Strait of Hormuz timeline. The next several days are described as critical, with attention on whether shipping resumes, whether mines are deployed, and whether U.S. and allied deployments translate into safe passage or further escalation. Evidence of lasting de-escalation, fewer drone strikes, and verifiable reopening of routes would justify the recent pullback in Brent toward $90 to $100, while renewed attacks or strikes on power infrastructure could force an abrupt repricing higher. That backdrop of unresolved Gulf risk is the stage on which today's volatility spike is playing out across equities, bonds, and commodities. Market behavior around this shock is defined less by fundamentals and more by headlines. Equity, rates, and commodity moves have become extremely sensitive to even a single social media post or off-the-cuff remark from U.S. leadership, with S&P futures swinging from nearly 5% down over 3 weeks to intraday rallies of 2 to almost 3% onto escalation headlines. Oil and precious metals are exhibiting classic whipsaw dynamics. Brent has repeatedly spiked above $100, at one point trading $16 higher intraday, before reversing to close more than 9 or 11% lower after talk of postponed strikes or potential talks with Iran. Gold has dropped sharply during these relief phases as investors take profits and react to a stronger dollar and higher yields, only to rebound on renewed conflict headlines. Rates markets are seeing some of the most violent moves since 2023. Front-end yields have risen for 5 straight days, with the U.S. 2-year up around 60 basis points in just a handful of weeks, and UK front-end yields up more than 100 basis points as markets rapidly price out rate cuts and flirt with additional hikes. At the same time, intraday swings have been huge, with Treasury yields jumping above 4% before retreating toward 3.83 as safe haven demand ebbs and flows with every geopolitical headline. Equity markets have reflected this instability with abrupt rotations between risk-off and relief rallies. European bourses are suffering their worst month in more than 3 years, with the Stoxx 600 down close to 2% in some sessions and all sectors in the red, while U.S. indices have seen futures drop nearly 5% from recent highs before snapping back onto escalation signals. Energy stocks that initially outperformed during the shock are starting to lag, down more than 1% at times, as markets question how sustainable supernormal profits are if oil prices correct on a ceasefire. Positioning is adding fuel to every move. There is an unprecedented level of hedging across equities, credit, and oil, with investors long volatility and protection in size. That sets the stage for abrupt short squeezes and sharp reversals when news tilts toward de-escalation, as seen in recent sessions where energy stocks slumped, travel and consumer names surged, and credit spreads tightened on a single set of headlines. Another feature of this regime is cross-asset divergence and fragile liquidity. Despite heavy equity swings, bond markets at times look less responsive to the same headlines, hinting that fixed income and equities may not share a unified macro view. Liquidity is also at risk, with perceptions of manipulation and mistrust around headline timing discouraging active participation and potentially amplifying volatility when genuine news hits. There are counterpoints to the more extreme volatility narrative. Some strategists argue that, despite the noise, equity reactions to oil swings have been relatively muted compared with past crises, suggesting that markets are already conditioned to look through headline shocks toward longer-term shifts in sector leadership. Others note that long-term inflation expectations remain anchored, tempering the case for an outright rates panic even as front ends reprice. This volatility regime has several implications. Asset allocation calls become more about scenario management than point forecasts, with portfolios needing to be robust to both a rapid ceasefire and a prolonged closure that keeps Brent above 120 or worse. Markets will be watching for confirmation on U.S. and Iranian intentions, the credibility of any ceasefire narrative, and whether upcoming data, such as global PMIs and inflation prints, validate the growth and inflation fears currently priced into front-end rates and risk assets. Against that unsettled backdrop, the next leg of the story is how supply chain disruptions beyond crude deepen and extend to shock. The Gulf conflict is no longer just about crude flows. It is morphing into a much broader supply chain disruption story. The closure of Hormuz and damage to around 40 energy assets have hit not only oil and LNG, but also knock-on sectors like fertilizers, petrochemicals, and refined products, with strategic reserve releases and pipeline rerouting providing only partial relief. Fertilizers and helium are emerging as important pressure points. Shutdowns of major ammonia plants and tight helium supplies are raising input costs, threatening margins along manufacturing and technology value chains, and in some cases forcing producers to consider price hikes that could feed back into inflation. Countries like Kenya, which sources about 30% of fertilizers from the Gulf, already face risks to agricultural output during the key spring season. Gas and power security are also under strain. Attacks on Qatar's South Par and other LNG facilities have cut around 17 to 20% of the country's output, with some capacity potentially lost for up to 5 years, contributing to Asian LNG prices nearly doubling year-on-year from roughly 10 to 12 to around 19 to 20 units. While storage and replacement cargoes may cushion the short-term hit, the episode highlights how vulnerable global gas trade is to choke points like the Gulf. Transport networks are feeling the shock from both energy and accidents. In the U.S., a fatal collision at LaGuardia Airport has led to reduced capacity and hundreds of flight cancellations, compounding pressure on airlines already grappling with surging jet fuel bills and volatile ticket demand. Elevated diesel prices also feed directly into trucking and logistics costs, broadening the inflation channel beyond pure energy bills. For corporates, these disruptions converge into a margin story. Rising costs for fertilizers, helium, LNG, refined products, and electricity are squeezing profitability across chemicals, agriculture, semiconductors, and heavy industry, and could ultimately require a wider equity valuation discount if pressures prove persistent. Equity markets are already reflecting some of this, with fertilizer stocks posting double-digit gains since the conflict began, while travel and energy names see large, but often quickly reversed moves as oil prices swing. At the same time, longer-term rewiring is underway. U.S. LNG is being revalued for its perceived security and military backing, with projects like Alaska LNG and record lease sales attracting strong interest from Asian buyers seeking to diversify away from Middle Eastern supply. Venezuela's output has risen, and strategic stockpiling of base metals is expected to increase, supporting long-run demand for copper and aluminum linked to defense and infrastructure build-out. There are also signs of resilience that temper the most bearish supply chain scenarios. Despite price spikes, LNG suppliers are prioritizing long-term contracts and investment, expecting market balance to improve over 5 to 10 years as new capacity comes online, and current disruptions are framed as temporary unless the shock lasts several months. Global trade, moreover, is seen as reconfiguring rather than collapsing, with firms diversifying suppliers and routes instead of retreating from cross-border commerce altogether. The watch list from here is broad. Investors are tracking whether Hormuz shipping resumes, how quickly damaged LNG and energy infrastructure can be repaired, and whether misplanning seasons or longer-term infrastructure damage translate into lasting scarcity for key commodities. The degree to which these supply chain strains show up in upcoming inflation data, earnings guidance, and regional growth figures will be crucial for judging whether the current episode remains a severe but temporary shock or evolves into a multi-year drag on global output. Taken together with the Gulf geopolitics and the volatility regime, this completes today's picture of a world where energy, policy, and supply chains are tightly intertwined. Energy disruption from the Strait of Hormuz, headline-driven volatility, and widening supply chain stress are now the dominant forces shaping pricing across equities, rates, FX, and commodities. Markets are trading a wide range of scenarios, from a quick escalation and lower oil to a prolonged shock with crude well above $100 and stickier inflation. Watching the next steps around Hormuz, front-end yield repricing, and how input cost pressures feed into earnings guidance will be critical for navigating this environment. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.